Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Thanks for joining us for this special installment of the podcast on the Property Investment Podcast Network or wherever you're tuning into this. Welcome. Also for those people joining us on the video stream, welcome as well as we unpack the Fast 50 report 2024, where to put your money today for the best capital growth over the year ahead. I hope you tuned into yesterday's podcast where we gave a real sense for the report, what we're trying to achieve with it, who's involved with it, the methodology, how to use it. And now we're going to start just picking through the report, giving different ways you can interpret and analyze and use the information to make more informed property decision. Now, Paul Glossop joins me in the studio from Pure Property Investment. Our partner for the report, Pure Property, has been a good friend of Smart Property Investment Show for many years, and they've partnered with us to produce this groundbreaking report where we've gone to the leading minds in Australian property investment to help us shape the Fast 50. And this is towards investment stock. There's a lot of reports out there, and usually it's sort of singular. It's one person's view of it. We're gone and asked the leading minds in property what their thoughts are, and we've looked for those commonalities of connectivity and sentiment to create the Fast 50. So this is where we're at, and I'm enjoying breaking this apart and pulling it down. But something, Paul, and welcome back to the podcast, by the way.
Thank you for having me again, mate.
One of the things that has really come out as part of this particular podcast is this notion of timing. Timing is absolutely everything. And I mentioned it in the podcast that we released yesterday that there's at least 50% of these suburbs on the Fast 50 report that I've never heard of. Normally the hot spots that you see in the papers, in the mainstream papers and other media outlets are probably the spots you should have been in 1, 2, 3 years ago. What this report is and what makes it so unique, it's looking ahead rather than in the past. We're trying to uncover those areas that you need to be investing in today to get the best capital growth in the future. It's about getting in these markets before other people get into these markets. What will happen, Paul, no doubt, we've touched on this beforehand, is that a lot of people will download this report and read this report and they'll do nothing about it. They'll miss the timing. And we spoke about it last time we got together around this notion of 90% of winning is beginning, or imperfect action beats perfect inaction. Choose whatever a narrative or whatever soliloquy you want around it all. The best people who do the best in property and the most effective in property are those that take action. If people ask me, what would you do different in property, Phil, if you had your time again? I've been investing for well over a decade. I would have done more earlier on when I could have, and I would have made the time to do more earlier on. That said, I've got a pretty good portfolio, but it could be a lot better, bigger, deeper, smaller, depending on the strategy I would embark on. But I should have done more when I could have done it. I could have taken more action, and timing for when I invested in property was great, and I timed the market well in terms of those areas I was investing in. I was investing in areas, Paul, in the western suburbs of Sydney that other people weren't. And I was only just the other day looking at some of the capital growth I've had on these things. They've tripled in value over that period of time. It's all about timing, isn't it?
Mate, you couldn't have said it better. I think it was Benjamin Franklin. It was something I was trying to come to my head, and it was a really good one, which, like you said, one of the soliloquies of that action. And essentially it was a job well done is better than a job well said.
Yes.
And it just, there's so many of these really simple quotes that, you talk about Western Sydney 15 years ago, 12 years ago, when you first started buying that market. And the reality is that you probably didn't have a heck of a lot of confidence in what you were doing at the time, but you knew that you had to do something. And, hindsight will tell you that, you should have had twice the amount of confidence and done twice the amount of things, because at that time you probably could have as well, but you were, somewhat bullish, and you probably thought you were being bullish, but you were sort of somewhat held back.
Yeah.
And I remember you and I having conversations 10 years plus ago when we were building our portfolios in those exact same markets, and we were sort of, we were sort of driving off each other at the time, thinking, "Oh wow, I've just picked up another one in that market." A bit tentative, a little bit
for
excited,
$250,000,
and freaking out a bit and thinking,
Yeah.
"Oh, I've got to put a bit of paint on the wall, and I don't know if this is the right market, and time will tell." And and we were sort of talking about the time, we were north of sort of getting into that top 1% of property investors as part of that overall property portfolio they're holding, knowing at the time that it's 1% of all property investors hold 6 or more properties, and starting to think, well, starting to push into that threshold way back then. You think, oh, am I comfortable being there? Am I overexposed? And lo and behold, here we are, mate. And we've all got those stories, and everyone listening will no doubt have exactly the same stories.
The same stories. And to be fair, we're not and I did it in conjunction with the buyer's agent.
Yep.
That buyer's agent is part of this report, Steve Waters from Right Property. So I had the right people on my team. I still have the same accountant that I had back then, sort of poking and prodding me. Just going, more.
And they've been there, done that.
I'm too busy.
And they have been there, done that too, because they knew. And again, going back to this time now, is that when I'm talking to clients, we know what happens over periods of time, and we know that people may be just needing that prod, that push, that arm around the shoulder saying it's going to be okay.
But if you've got the right people, typically it should be okay. And if you're tuning into this, it means you're investing in your property education. So you've already got a huge advantage, because a lot of people that don't, they'll just go to a seminar and buy some apartment in a 600 apartment off the plan thing, which will fall down.
And I don't want to digress, Phil, but I guess to that point, and why this report is so important, and why taking action on something like this report is so important, I still have conversations today with new clients who come my way who talk about properties they have in their portfolio, and the reason why they're trepidatious about buying property is that they're not because they haven't bought property, but it's because they bought the wrong property quite some time ago, and they have a huge hangover and an issue with trust, and an issue with just property being a vehicle to make money. And generally it comes down to, I can't count how many clients I've had who have off the plan apartments that they bought in Docklands in the 2000s. And I don't necessarily specify that area in particular is terrible. It actually is probably going through an okay time right now, but that type of asset, when we had this enormous boom of off the plan sales of these 50-story buildings, which were taken 3 or 4 years to get out of the ground, and they paid $550,000 off the plan, and it's worth $550,000 now, 15 years later, they have a completely different opinion on property as compared to you buying your first freestanding established 1960s house on a 600 square meter block in Campbelltown in Sydney for $250,000 15 years ago, which is worth $800,000 now and has been cash flow neutral the entire time. Your opinion on property is pretty positive.
Yeah, beauty is in the eye of the beholder. And I was in Docklands recently, and to your point around timing, it's the when, but it's also the what.
Yeah,
like you could time the Docklands market really well if you know exactly what you're doing, or you get really, really lucky.
Yep.
But timing doesn't need to be a trickery, marvel of trickery, right? Like timing should be simple.
Yeah.
And when it comes to timing in property, if you can invest in property, invest in property.
Yeah.
So I made it really, really simple. If you can afford it, if you've got your finances sorted out, if you've got your family balance sheet sound, if you've got your ability to manage potentially negative cash flow or fluctuations to the market or interest rates, invest in property. If you haven't got that sorted out, don't invest in property. But then it comes down to, okay, it's the right time for me to buy. And then it's about timing a particular market. And it's about identifying the markets you need to time. And the Fast 50 report, in many ways, is to help people out. This is where to put your money now for the best capital growth in 2024, helping them time a market. And as I said, there's 50% of these markets I've never heard of.
Yeah. And asset classes is probably the last one I'd touch on there, Phil, is that we talked touch on very briefly there about Docklands, Melbourne in particular, to apartments in specifically high-rise, newer apartments. How many, as the curator of this report, how many of these properties and markets, as far as where these experts have advised, are those asset types, be it high-rise apartments? I'm not talking about low-density 4-pack, 6-pack, 8-pack, but out of that 178 that was originally contributed, it's probably more a question to yourself, man. How many of these were high-rise apartments?
Well, I actually haven't done the overlay, but every single property, we don't rank. We're not listing units here. This is all houses.
And that came from the original recommendation, because the actual original larger list was exactly that too. And I'm not discounting certain areas which boutique low-rise apartments actually do feature quite well. And we've bought enough of them in our time to know that they do work. But that specific asset class, I know out of all those experts that are in this report, not one of them has recommended that property type.
Yeah, we've gone houses. And the reason why we've gone houses, we've said, where to put your money now for the best capital growth in 2024. And fundamentally, I know a lot of people done well out of apartments. I've done well out of apartments.
So have I, mate.
But it doesn't, compared to And a lot of that is budgetary constraints, right? But how units, unless you get a Hail Mary, they don't move the needle as much as houses. That sounds a bit simplified, but it's pretty common amongst people that operate inside of property, particularly organizations like yourself, who help Australian investors locate property and create really good strategies around wealth creation through property investment. Houses normally brings home the bacon, right?
Yeah, they typically have a much more of a scarcity in regards to land over time. And I guess the reason why I sort of also mentioned low-rise apartments is that it does have the same aspect. If you're talking a 4-pack, 6-pack, 8-pack on 1,000 square metre in an area which you've got high-density zoning, essentially the land is still the main acquisition of that purchase. So that's exactly what we're talking about here, is that houses, or the value of the land in which you're buying that asset on, is what's going to move the needle over a longer period of time. It's pretty simple.
Yeah, and that's what you want. You want to move the needle, right?
That's it.
You want to move the needle. That's the idea. You want to get in there and make sure that where you put your money today is going to get you the best return in the future. And to your point around Docklands, I was down there. A couple months ago. I was there like Monday to Friday. Whatever. Monday to Saturday. I can't remember what it was. And I stayed in one of these high-rise things, right on the water. It's a service apartment, right? 2-bedroom. Okay, as you would imagine, it's pretty bog standard, right? Like
sterile.
It's sterile. Probably worth $800,000, right? 2-bed up. I can't remember what I had to pay an eye for it. $400, say.
Right.
I'm
assuming there's a lot more knowing your budget for
me. I tried the backpackers; it was full. Don't worry about it. But I sat there and I remember sitting there going, a property investor owns this.
Yeah.
I went, a property investor owns this. And I looked around and I went, it's a bit tinny, like it looks okay, but it looks a bit, doesn't feel cheap, but it's not like fancy, right? Like, it's not fancy. And it's going to be exactly the same as the 500 other apartments in that same area. And I sat there going, this must sit here empty a lot of the time. And they've given it up to there's these aggregation companies now that list and market these things and put them out. And I just went, I'm so happy I don't own one of these in my portfolio. And that was sort of juxtaposed with the idea of like, I was out, I was working hard, I was doing a lot for work, I was coming back after cocktail receptions, which is I seem to do a lot in my life. I couldn't get a bite to eat anywhere.
Like, because they were closed.
There's nothing open.
Yeah.
There's nothing. And so I've gone, you've got all these high-rise apartments to try and create a community. There must be literally thousands of apartments in Docklands, right? Yeah. Mate, good luck trying to get a kebab at 10 or 11 o'clock at night.
It's a sad state of affairs.
But I said, it's completely wrong. It's completely wrong. It's on topic, but off topic, going, if you want people to live in these places, put the amenities around. There's a nice park down the road. There's a basketball hoop where some people could take it to the D. But, mate, it was soul destroying. And I went, those people who have put their money into this particular apartment, it probably might have made a few bucks depending how long they bought it. They might have tied up their money for 3 years. 3 years to actually get the thing built out of the ground so you can start renting it.
And that's realistic.
That same money that they paid on the deposit of that, they could have got a couple of these assets somewhere else at the same period.
And that
of time.
comes down to what we're talking about now is timing. And the cost of essentially
the cost
delay,
of poor timing,
and the cost of committing your money in a time where you've absolutely taken yourself out of the game for a period of time. If you bought something off the plan and you've got 2 or 3 years for that to come to fruition, and what could have otherwise happened with that same amount of money, it's an enormous thing when it comes down to it. But as we're speaking, mate, I just brought up the details of units in Docklands from a capital growth perspective, and I guess to share that specific timing over the last 10 years with the viewers. Have a wild guess at what Docklands, and this we haven't looked at.
What average annual growth?
Average annual growth over the last 10 years. If you bought a unit for $600,000 in 2013, what is that same unit worth if it's run-of-the-mill generic unit in 2023 today?
So, by the way, this is the first suburb we've mentioned as part of the Fast 50, and it's not one in the list.
It's not one in the list.
And it's the showcase.
And it's off the cuff.
Bad timing.
Completely off the cuff.
Okay, so you bought it for $600,000 10 years ago.
Yep. And let's say you bought it off the plan in 2010, and it was, and let's say it settled in 2013.
What price point it is?
What price it's worth?
Or the growth?
Well, I'm looking
average
at the
growth.
growth.
Okay, I reckon average annual growth of maybe 1.8%.
You're not a long way off, but that same property, if you paid $600,000 let's say $17,000, which was the average unit price of Docklands in 2023.
Yeah.
The average price today, $622,000.
God,
That's a mic drop moment. Like
so it hasn't gone up.
0.7% increase in value in 10 years, accumulatively.
Accumulative, not even average annual.
Not average annual. It's and that would be devastating for someone's future plans. And this is everything about this report, and this is everything about timing, is that you can do nothing or you can do the wrong thing, and a lot of the time they will both have an exact outcome, which is essentially zero.
So going to the data,
Yep.
Paul, so we're talking about average annual growth. That's a common way you can measure performance, right? The highest average annual growth on the list, Mickleham in Victoria, 16.6%.
Over the past 10 years.
Over the past 10 years, median quarterly growth 2.8, 12-month growth 10%. So that's coming down. Right, it's coming down.
Yeah.
A suburb that I believe you used to invest in, Rokeby.
Yep.
7019 in Tasmania, 11.5% average annual, 12-month, 11.8, quarterly growth 3.2. That's still doing
good.
Pretty well.
Yeah.
So you're not there anymore.
We're not there anymore.
Okay.
Not there anymore. We were there 4, 5, 6 years ago. Timing, and you could imagine what happened to those clients we bought 4, 5, 6 years ago.
Yeah.
Exponential.
Yeah. Okay. So let's look at the bottom of average annual growth, right? And
this is in the Fast 50 list.
This is the Fast 50. This is the actual Fast 50. And as you will be surprised, nearly all of them. So the bottom performing 16 suburbs in average annual growth, 15 of them are in Western Australia.
There you go.
As you would expect,
Yep.
right? So the worst performing average annual growth, 10-year average annual growth, or Aurelia 6167, 1.2%.
Yep. Not surprised at all.
12-month growth, 13.4.
There you go.
3-month growth, 4.2. So it's in its ascendancy.
Tell you a very, very interesting
Tells you the
story.
clues. Tells you the clues. And look, I'm not here to beat up Docklands.
No.
But I'm happy I didn't invest in there, to your point.
Absolutely.
So over 10 years, it's hardly moved the needle. And you think about it, people would have subscribed in, they would have signed a contract at least 2 years prior, potentially to secure that. To put 10% down. So their money's done nothing.
And if anything, they've probably lost maybe 20, 30 grand in stamp duty transaction costs, excluding holding costs.
Yeah. And let's talk about the mortgage, the negative on the mortgage they've been paying the whole way through.
Let's average at 5, 10 grand a year. So you might say that they're actually behind 100 grand.
Yeah. Sounds like a tax deduction strategy.
Yeah. And I dare say if that unfortunate person
So by the way, we you can't see us. We're sort of like, yeah.
But ultimately, I dare say they'll probably still have a dusty old marketing booklet, which probably started by saying, you're paying too much tax. You're earning over $120,000 a year. You're aware that we can negative gear this and you can get $10,000, $12,000, $15,000 back on an average taxable salary of your kind. Yet here we are 10 years later, that same product has probably lost that same person $100,000 on the actual value. But then you say, what was the opportunity cost? And Phil, take out of the equation this Fast 50. If you bought that $600,000 or we put that $600,000 into, let's say, two of your Campbelltown properties that you mentioned at the start here, what would be the net effect? What would have been the net effect in that same 10 years?
You wouldn't want to, if you're one of those people, don't do the math. Like, seriously, don't do the math yourself.
There will be so many listeners who, unfortunately, and I'm not trying to beat them up, but this is a point in time where there's still time. For the vast majority of people who are listening to this, there is still time here to make a massive difference. But if you're saying, hey, you had 60 grand you put down, and if you put that across 2 assets, $500,000 each, that $500,000 worth $1.5 million. So not only have you lost in that same instance 100 grand on Docklands, but you've probably lost the opportunity to see $1 million in capital growth. It's $1 million difference.
And it's all about timing and asset selection.
And this is nothing exceptionally complicated.
No, it's simple.
And we talk about timing and this guide. If you start to think, how could I implement what's in this guide and fast forward 10 years and talk about being one of those positive statistics instead of one of those negative ones, if that doesn't get you to really start to stand up and pay attention, nothing will.
See, a lot of people, though, and maybe you give some insights on this, and I'll be interested how you respond to this, but there would be people with those properties, and they're probably the most Australian investors own between 1 and 2 properties because they probably own investment properties because they probably purchase properties like that, right?
Yep.
Do people feel like they don't want people to know about it? Like, do people come to you and feel embarrassed that they've done that and they want to talk about it? Because I imagine a big part of your job at Pure Property is fixing ineffective portfolios and resetting them and getting people to move ahead. Like, you guys aren't judgmental in that stuff. I imagine you probably get great satisfaction out of resolving these issues for people.
Massively. And if anything, I'm quite privileged, and my team who get to speak to our clients actually do feel really privileged, because by the time someone picks up the phone and actually sets up a time to talk to me, which anyone can at purepropertyinvestment.com, we can literally lock in a time to discuss your Docklands issues. And hopefully there's not that many of them, but potentially making a decision that might be a future Docklands issue or an alternative. By the time they've done that, they typically are people who are comfortable saying either A, I've made a mistake and I'm happy to talk about it, or B, I'm a bit nervous about a decision I'm about to make and I maybe want to get a second opinion. But the beauty is that we obviously, what we talk about is ring fenced within what we talk about. So this doesn't become public information. But most people in the property investment space inherently are proactive. And by being that type of person, it's kind of like an athlete trying to better their skills. Majority of the time they're saying, look, I messed up here. I know there's better ways to do it. I just don't want to make that mistake again. We can park the mistakes that are made in the past, and we may have to discuss an uncomfortable situation of selling an asset at a loss, and then maybe we can carry that loss forward for any future property investment. And there's different strategies.
By the way, speak to your accountant about that, because if you have made 100%. A loss, if you fix your portfolio, you get to realize the advantages of that loss in the future, because not giving tax advice, but you're probably going to have to pay less capital gains tax on that basis.
Exactly, mate. And I think that's it, right? A loss isn't a loss. A loss is a paper loss until it's realized and it's sold. But even then, if there's an actual physical loss on paper, and you're planning to continue to build your portfolio, there's ways to carry future gains and exclude those losses and really reduce that taxable side of things, which is a separate discussion.
So you might take a haircut, but you could probably ameliorate it over time.
Yeah, highly justified.
So this goes back to timing. And by the way, this is not a beat up on Docklands. This could be anywhere like that, right?
I could rattle off 50 Docklands.
But it's about giving a sense of timing and market allocation. Timing the market right. If you time the market right, you get the greatest utility out of your money. Now, the Fast 50 report is about where do you put your money today to get the best outcomes for 2024 and hopefully beyond. So timing is absolutely key. If you can do it, but time the market right. Now, there's a lot of locations in this report that you may not have heard about. And this is counter-cyclical, the notion of counter-cyclical investing. This is about when everyone else is sitting on their hands is the best time to be moving into a market. The reason why is that you've got less competition for properties, and typically you have more sellers there. So you got greater chance of securing really, really good assets before the hordes get in. Now, and I'll be interested to see how from real estate agents in these areas as part of the Fast 50, what sort of increase in investor queries come out of it. And what stock on market is in these locations right now, particularly a lot of these locations in Western Australia. And I look at some property sales data for them, Paul. Falcon WA, 223 sales last year. Rockingham's a regional one. I think you're buying there, 256 sales. Greenfields, 321. Maddington, 234. So there's transactions.
There's majority of sale at least every other day.
There's 20 a day, 20 a month, right? So there's stock on market, but as these prices start moving, you'll see more stock come on market.
And supply is tight.
The other supply is really tight at the moment.
Data doesn't necessarily talk about, and there is other overlays that we look at purepropertyinvestment.com is saying, well, total amount of supply as a long-term average as well, and you start to get understanding of graphs. When supply starts dropping, sales volumes start increasing, that just exacerbates the issue of less property, less time on market, higher prices increase. But I think one thing that's really poignant that I want to maybe talk to the listeners about today is about timing and implementing this guide and taking some action here is if we looked at, let's just say, and we'll talk about the compounding effect of doing nothing. And let's say we pick, let's pick Rockingham as a market in WA right now. What's the average price there, Phil? And I'll do some actually live numbers with you. What's the average price?
Rockingham, 477,500.
All right, let's say 477,500. So if we bought a property for $477,000 today, and if we held that property for 15 years, and let's say that that property achieves 7% average annual growth over the next 15 years.
Well, I can tell you it's been
The last 10 years, I can guarantee it was a lot less than that.
2.7%
There you
average
go.
annual growth last 10 years. 12-month growth. So what's happened last 12 months? 9.8%.
So let's say we'll draw a line and say it's below that, but let's say 7%.
Yeah.
So over 15 years, that same property, fast forward 15 years, be worth $1.317 million.
And over what time?
15 years from
See,
today.
people just go, there's no way in the world that a property worth $477 is going to be worth that much money.
Go back to your Campbelltown property.
That
There's no
happens,
way
right?
a $250,000 property will be worth close to $1 million 10 years later. It happens. But let's say you chose to not buy that property this year and you pontificated, you oscillated, you waited, and essentially you got that 9% average annual growth that's happened a bit over that in the last 12 months. Let's say that happens again over the next 12 months. I'll say it's 7% growth again, but we're waiting another year. So we're buying that exact same property for the exact same price, but we're buying it this time next year. The net effect of delaying and not taking action. So let's say you actually did take action, but you delayed that action. That same outcome, which we talked about, what was the number I just rattled off? I think it was 1.32.
It's a little bit less than that, but yeah.
1.32 we said it'd be worth in 15 years. That same property, essentially, if you bought that property this time next year and held it for that, instead of 15 years, you're holding it for 14 years, $1.23 million. Still an amazing outcome, you'd assess it. But by not taking any action in the next 12 months versus taking action immediately, it's an $80,000 difference just by taking action. And then you extrapolate that over another year, and this comes down to the haves and the have-nots.
Yeah, and this comes down to some of the tactics you have in relation to getting in earlier. And by that, I talk of things like what do you call it? LMI, lender's mortgage insurance. So this is an insurance policy that can get you, which insures the lender in case you default on the loan. So you don't need lender's mortgage insured under an 80% LVR. There's some lenders where you don't need it under 90%, but if you're going to be borrowing at 90% of the value of the property, you're going to have to take out an insurance policy, which might cost you, I don't know, on I'm going to pluck this number out of the air, but on 477, it's probably about $6,000 in
About
LMI.
that,
You reckon about that?
Plus or minus a grand.
Plus or minus $1,000. So you get in today.
Yep. Spend that money.
Yeah, instead of saving that money to get into the same time next year, where you take an $80,000 haircut in 15 years.
Made you $72,000.
Yeah.
Or $74,000.
Yeah.
I mean, imagine you could take those odds on any kind of other bet. You could spend $6 to make $7.
And I'm not promoting people use LMI, by the way, but there is tactics available to you. Yeah.
And you're exactly right. That's the tactic, because a lot of people think, I've only got $55,000 saved up. I need to get to myself to 95 to get into that particular property because my broker said for a 20% deposit you need 95. Well, they haven't necessarily talked about the other tactics, or maybe you have your own biases around LMI is not for me. I only do 20%. Well, it's a tactic. It's an implementation tactic. If applied correctly, can triple, quadruple, 5x, 10x your money in certain instances just by executing.
So what did you use there to do those sums?
Anyone could go there really quickly, and it's the Money Smart. So moneysmart.gov.au, government website. If anyone wants to start thinking about this and pluck the numbers, plug them in there. There's other things there for superannuation, compounding facts as well. It's a fantastic free, and you can actually get an app on your phone as well. So plug to the moneysmart.gov.au. But it's such a great tool for anyone who likes to think, well, maybe I'll wait till next year. Plug the same numbers in and postpone a year, or start to do some math on what you hold now and do some compounding growth over the next 20 years at a 5%.
Or if you get tactical, go drive Ubers every weekend for the next sort of 6 months so you can get the difference between a 90% deposit and an 80% deposit.
Absolutely.
You know, that's the hard facts. They're the hard facts. So that's all about timing. The sooner, and LMI can be an enabler for people early on in their career, right?
Absolutely.
If you buy well, your investing career, if you buy well at the start of your investing career, typically you get increasing equity that you can recycle, and you don't really need LMI moving forward. So a lot of people use it, are kicking off, but the sooner you can start, the better. But make sure you're buying in the right spot beforehand.
Correct.
And hopefully we've identified some of those areas in Fast 50 report. But just be careful also. I would caution, because there is one suburb here, Paul, average annual growth of 8.7%, 12-month growth, median quarterly growth of 2%. So it's been growing pretty stable.
You take that.
Yeah. 12-month growth, 60.2%. Where is it?
It'd be acreage, or it'd be waterfront.
Yeah. Leppington.
There you
New
go.
South Wales. So if you looked at that in isolation and went 6% growth in 12 months, like how does that happen? Someone's absolutely killing it, but it's only been growing at 8.7% average annual growth. Something's not right.
Which is still fantastic.
Which is pretty good.
You'd still also take.
By the way, I did an average. I did an average of the Fast 50 of all of the average annual growth. So it's an average of an average, right?
This would be interesting. Right?
Average of an average. What do you reckon? So this is not the median. It's the average of the average. It's the aggregate
of the Fast 50 or the 178?
Of the Fast 50.
Okay. I wouldn't be surprised if it's below the long-term averages of 7-ish% personally, because that would be actually a relatively sound sign for me.
Yeah, it is because, and I think it gives us some sense of the integrity of the report. We're trying to work out where to put your money today for the
not
best capital
what's
growth
performed
in the
ridiculously over the last 10 years.
Yeah,
it's saying,
and there is 14. Sorry, there's 13 of the locations of the Fast 50 which have under 3% average annual growth, right? So that gives you some clues. You're absolutely right. And at the top end of this, when I take them out, it would change things quite a lot. You've got two suburbs, Mickleham 3064 and Rugby 7019, over 10% average annual growth, right? But let's keep those outliers in there as a collective. 5.32% is the average.
There you go. And that's well below. That's probably a good 1.5% below the national average for freestanding established houses.
So this is about timing, right? Like how to time it properly.
And this is probably speaks again back to timing.
Sorry, the bottom 20.
Yeah.
Average annual growth, 2.69%.
There you go. And yes, some would look at that and say you got to have rocks in your head to invest in any markets that show that. But this is the reality: is that we talk about timing, not only taking action, but also we talk about time in the market. A lot of the time, that's a lazy person's analogy to say, well, time fixes all property investment mistakes, and to a degree, it does. If you hold for long enough, you'll get the average. Yeah. Well, give it 30 years. Yeah, this is a reality. People talk about long-term 50-year data. Every single property in Australia, averaged out over the last 50 years, is about 8.2% average annual capital growth over the last 50 years. Freestanding established houses.
If you can get 8%, you'd be happy with that.
You'd be exceptionally happy.
But that's compounding,
right? And that's where long-term. But I guess the whole point in this is that we're talking about where to put your money for the next 12 months for the best amount of 12-month growth. We're not talking about 15, 20 years, but in saying that, the reality is the secret sauce is here, because that will likely tell you that you're going to get quicker than the average, and you're then going to be able to recycle
faster than the average bear.
There you go.
All right, that's good. So it's all there. Fast 50 report, go to smartpropertyinvestment.com.au. And if people just go, I sort of get what these guys are talking about. I'm one of these people who probably didn't buy right. Can I fix my portfolio? They can come and speak to you and your team, right?
Unequivocally, mate. Yeah. That is 100% what we're here to do, is talk about mistakes, talk about future opportunities, and try to put the best plan possible together to fit the budget and fit the future objectives as well as the cash flow requirements. So purepropertyinvestment.com, and they can lock in some time to speak with me directly. Hopefully, they've already downloaded the Fast 50 guide before we catch up, because a lot of that is going to be potentially what we can talk about. Not to say that we're going to be recommending 100% of market within that guide, but I can tell you that this guide is some pretty secret sauce.
Yeah, that's good. All right, go and if you need help, you can phone a friend. Go and speak to the team over at Pure Property, and I know they get a kick out of this, right? Because one of the reasons why we do this podcast and the Smart Property Investment Show and Property Investment Podcast, now we're in special series like this, the Fast 50, and reports like Fast 50, to help educate people so they don't make those decisions. You're better off not having to fix a portfolio through poor timing or asset selection. You're better off building fit for purpose and understanding those tactics available to you. We spoke about one of them just today about timing and everything. Go and have a play around with that Money Smart calculator as well. I don't mind sending people to the government website. It's pretty good, that thing.
Yep.
So go and check it out. All right. Hope you enjoyed that. Come back tomorrow. We'll have another podcast as we break down the Fast 50 report. Download it now so you're a bit more informed for when we get stuck into it. And this hour we'll talk about the data, anecdotally at least. I think the most boring thing in the world is just go, property number C is this and the other. So we want to give context, interpretation around it. But I think the key message to this, there's two. Number one, what is the focus of the report? Where to put your money today, timing. Where to put your money now for the best capital growth in 2024. Second bit, do something about it. Don't be an armchair investor. Do something about it. If you can do it, the timing's right, if you can afford property, if you can afford to expand your portfolio, if you've got your finances sorted out, if you're comfortable about your financial situation, if you've got some rigor in your ability to maintain potentially negative cash flow for the trials and tribulations of property, do something about it. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.